Hello, David Moore with Equity Advantage, and I've got Robert Smith of Peregrine Private Capital here joining me today. And this segment, we're going to talk about institutional investments. And actually just want to talk about, sometimes we've got people in a situation where they're giving up smaller properties and they're concerned about maybe a downturn in the economy, and they might be concerned about a sponsor or buying into something big, what kind of impact they'd have personally. And I guess the thing that I always talk to them about is say, look, if there's an economic downturn, what's your ability to deal with that downturn versus somebody that's this large sponsor that's been in real estate for 40, 50 years. I mean, you have any comments regarding that, and institutional versus mom and pop owned, and what might happen in a hypothetically recessionary time?
Plenty of comments.
Plenty of comments.
Not a problem. I think
the hook.
Bait the hook. And I just bit.
Yeah.
The primary concern of most people when in 1031 exchange is control, because most people, most mom and pop property owners have controlled their assets all their lives. And so it's so if something goes wrong, I can fix it. In ordinary circumstances, that is true. In a serious economic downturn, if indeed one occurs, your ability to control circumstances and affect your destiny in a positive manner, I think, is very limited. And I think that's one of the principal advantages of DST in the context of a major downturn. We've already talked about the advantage of diversification. Well, institutional property management, particularly if your DST is being operated by a large, credible institutional entity with a track record in the commercial real estate space, they may have capitalization, resources, abilities not otherwise available to you if things go down and deep, okay? And so that may actually be a benefit and not a detriment. No, you can no longer control the asset, but if you do your homework in terms of who the property syndicator is, what their management track record has been, then you may actually have more resources at your disposal through that institutional entity in terms of greater capitalization than you have yourself. And that could be a real advantage.
So if we look at another, I was just listening and thinking to myself about the people that we have going into your products. And if we look at in recessionary times, typically we have a reduction in value, which ultimately leads to a reduction in equity. And we, at the same time that's happening, we've got lenders that have a lower loan to value, and which leads to the big fallacy of in 1031 you have to replace debt, which if you've seen my videos, you've heard me say over and over and over again, that's not true. But I'll just say it again, debt can go away two ways, one by going down in value, the other by adding cash. And I think the thing that's important for people to understand is that if we're looking at that hardship, you might be in a situation where you can't get the loan you need to complete the transaction, and if you don't have the cash to offset the debt reduction, your product often, it's all non-recourse debt. So each offering is going to have an LTV that's a different level. And if you've got somebody coming in and maybe they don't have any debt on what they're selling, obviously you've got product that's zero debt, and it's going to have a different sort of, what's the word I'm looking for, or just a bundle of benefits than something that's leveraged necessarily, right? But you're going to be able to accommodate stuff. But I want to stress that sometimes you might give up a property that's 60, 65% loan to value. You might go to Bob and say, okay, gee, this is what I've got. You might have the perfect property that's 50% loan to value, and they think, well, gee, I can't do that. But you've got ways to fix that if they don't have the cash to add, correct?
Yes, we do.
Yeah.
Yes, we have highly leveraged what are called zero coupon DSTs, which are institutional quality properties that are very, very aggressively leveraged say 80, 81, 82%. And like a zero coupon bond, they do not pay out interest or they do not pay out rent on a monthly basis to investors. That monthly rent is paid into the property and retiring debt in a very aggressive manner. And those are designed specifically for people who need more debt from a replacement standpoint than is otherwise available in the current market. And you can buy bits and pieces of that to reach your debt replacement threshold.
So think about what he just said, and we've done. I mean, we were doing mop up work from the last recession until probably 2-3 years ago now with institutional falterings. And we would have people exchange out of a property, you have phantom gains. So if there's a foreclosure or short sale in the residential world, there's some tax relief. On the investment side of it, there's not. You're going to be subject to something called phantom gain. So what I'll just further stress this, if you look at, you say, well, how can I lose everything and have a tax consequence? Well, the government's going to treat gains the difference between your adjusted sales price and the basis and the property. In a foreclosure, the debt is considered to be the sales price. So if you've got a debt over basis situation, you could lose a property foreclosure or short sale and still have a tremendous tax hit. So what we were doing in a lot of that when we were cleaning up those problems, they'd go to you and you'd put them into one of those zero coupon situations. So once again, I want to stress, you said some of them were up to 80% loan to value. Now, if you look at what people would have lost in a foreclosure and the tax repercussions of that phantom gain, the tax liability might be as much as up to 40% on that. So you're able to get them into something. So think of this, you lose a property, you're subject to the tax. We set up the exchange, isolating the taxpayer from debt relief in this situation, not the gain attributable to appreciation, is just debt relief is what's going to trigger the tax in that scenario. And what I'm saying is it could cost you more to walk away than to exchange into one of these zero coupon offerings.
Correct, yes. And those offerings are available on an ongoing basis in the DST space, they don't go away quickly because they're usually big offerings, and again, they're made for people who need bits and pieces of additional debt. So it's certainly something worth consideration.
But he's going to be able to look at what your situation is. If you've got a certain loan to value that needs to be met, you're going to sort of mix and match the assets at your disposal to get these people where they need to go. Sometimes it might require adding some money to be totally deferred, but I want to stress that 1031 is not all or nothing either. So,
correct.
Yeah, okay. But as far as people's, I think one of the big concerns people have is they're handing you the keys to the kingdom, right? I mean, when they're giving up something their whole life, like you said earlier, they've been building things, it's all been on their back, and then all of a sudden now they're sort of handing things over. But I think that the thing we need to stress in today's world, and it's certainly a different world than it was 2 years ago, with respect to what the government is able to do or should be doing, but they certainly have inserted themselves in a spot that I'd never dreamed they would have in different situations. And I think that if we're looking at for example, if I own a property, my ability to handle an adverse situation, a dramatically adverse situation, versus somebody that's the size of Inland, for example, they've got to be better prepared with teams of tax and legal people and finance people and everyone else to deal with these assets in a rough time.
Right. I mean, you're buying more than the individual DST property itself. You're buying the institutional expertise of the people behind that DST program and other programs. So that, again, is a very, very, very important point an important part of your research with regard to DST in terms of, who's driving the bus, what's the track record of these people, what have they done when things have gotten bad, what resources do they have available to them to fix challenge properties in bad times, because it is real property, as good as due diligence is. things we don't anticipate happen, and so you need to have a management team that is good enough and has a strong enough resource base to address that when something like that happens.
Thank you. Good answers. David Moore, Equity Advantage, Robert Smith, Peregrine Private Capital, and come back in a couple minutes. We'll be talking about diversification, all things diversification.
All things diversification.
Thank you.